Oil prices heading up again today. Concern over unrest in the Middle East and North Africa pushing crude past $102 in New York trading on the NYMEX. So what will $100 oil mean for consumers and investors? My next guest might have an idea. We've got Rick Bensignor, Chief Market Strategist at Dahlman Rose, and joining us, Sebastian Mallaby, Senior Fellow of International Economics at the Council on Foreign Relations, joining us from Washington. He also is the author of the book, More Money Than God. Sebastian, let's begin with you. Oil prices heading up $100 a barrel. We've been here before. Is it going to stay this high?
You know, I think it is. The reason I think is that, oil is sort of like gold last year. Oil is the new gold. And the reason I say that is if you wanted to hedge sovereign credit risk last year because of Europe, you bought gold. And if you want to hedge geopolitical risk in the Middle East right now, you buy oil. And it doesn't matter what your directional view is on oil. You need a percentage point or 2 percentage points in your portfolio just because it's very negatively correlated with stocks right now. So I feel like that's enough buying pressure right there. The uncertainty around Saudi Arabia, whether it's really stable, kind of creates a tail risk in the oil price, which people are going to price. So although if you talk to refineries, you look at stocks and so forth, you don't see why the price should have gone up so much. If you think more broadly, it makes perfect sense from a sort of trading perspective that oil should be up and should stay up until the Middle East calms down.
Rick Bensignor, oil, the new gold, oil going to stay at these current levels because there are a lot of people who are looking at the portfolio going, yeah, I understand what Sebastian Mallaby says. Yeah. I got to have a couple percentage points of the portfolio in oil just in case.
Makes sense. We've also got, on the commodity side of the business, the Commodity Futures Trading Commission puts out their Commitment of Traders report every couple weeks. The last report showed over a 50,000 contract swing between shorts and longs flipping positions. So you've got a huge speculative element in here, too, buying oil. It's not just hedgers playing against each other. There's the public, there's funds in here.
But no one wants to be a seller, right? I mean, if you have the ability to be a seller, if you're a natural long, right, you don't necessarily want to be selling out your positions because you're worried that you're going to have to buy it back at a higher price.
Well, it depends. If you're a natural seller, chances are, as markets rally, you actually lay out some inventory to them. Gold producers did it on the way up, and perhaps it cost them some money because gold continues to fly. But natural, true commercial hedgers do use rallies to lay out inventory. So at least you have some people on the other side of the market.
Sebastian Mallaby, is it possible that Saudi Arabia just picks up the slack? That's what we keep reading. That's the second paragraph of almost every oil story, that if we have any kind of disruption in terms of supply, the Saudis come riding to the rescue.
Right. Well, that's true, so long as we're just talking supply disruption of less than 3 or 4 million barrels a day. So, Libya, you could take out the entire production of 1.5 or 1.6 million barrels a day, and the Saudis have more spare capacity than that, so that's not a problem. The problem comes when you've got Libya plus, it could be plus Algeria or plus some other place, or when the trouble actually leaks into Saudi Arabia. I work at the Council on Foreign Relations. I hang out with geostrategic types, and for the last 2 weeks, they've been talking about this, and they've been saying, gee, Saudi Arabia is a country which has got some of the oldest rulers in the world and one of the youngest populations in the world. So you've got a generational conflict. It's got large amounts of disgruntled Shia minority. It's got lots of unemployment amongst the youth, which is another factor for instability. So there's a lot of stuff going on there before you even get to the fact that this is a society that educates its women and then makes them go out in the street in medieval garb, and they're not allowed to drive cars. So you have to assume that half of the population right there is not too happy. So there's a lot of brittleness in Saudi society, a lot of opacity from the outside. We don't know if it's stable, but we do know there is a risk. And what we learned from the financial crisis is that you should price tail risk.
Rick Bensignor, Sebastian was talking about Libya, saying that, all right, if Libya goes offline, the Saudis can come in and they can pick up the slack as long as it's just Libya. Mm-hmm. What happens if this no-fly zone gets somehow set in place, and not only set in place verbally, but there is some kind of military operation that is supported by NATO or EU or United States forces. Does that throw all of the predictions out and oil just does its own thing?
Well, look, if for every roughly, I'm not an economist, but for every 20% or so move up in oil, you're talking about taking about 25 basis points off of GDP. So year over year, we're already up 25% in oil. We've just, if you add another 20% from 100 and you push oil to 120, you take another rough 25.
It's like a tax on people.
It's a huge tax on people. And they've seen it before because a couple years ago, we were up over $100 for about an 8-week period.
Right, 147, right, was the high, was the top print.
And it took about 5 weeks once we broke through 100 to hit 147, and then only about 3 weeks to get back down to 100 on the way down to eventually what went to 33. We know at $4 gasoline at the pumps, people can deal with it, but they're not happy. If we get much above $4, let's say you start paying $4.50 to $5 by the summer or the fall, that will clearly impact people's spending. And the difference now also is the unemployment situation and the numbers now at where unemployment are now versus where they were 2 years ago. It's much higher. So you put $4.50, let's say, gasoline at the pumps with 9% unemployment, you have a totally different picture here, and it really questions the whole sustainability of this recovery. In fact, do we really have a recovery that's true, or is it more artificially pumped up by the Fed?
Well, indeed, we're going to talk a little bit more about that because we had Federal Reserve Chairman Ben Bernanke testifying on Capitol Hill today, talking about inflation, talking about jobs. We've got much more with Rick Bensignor of Dahlman Rose and also more with Sebastian Mallaby coming to us from the Council of Foreign Affairs. Sebastian, hedge funds, the front page story in the Financial Times today, they made more money than all of the top 10 banks combined. Top 10 hedge funds versus top 10 banks. What was it, 28 billion versus 26 billion? What do you need all those banks for if they can't make as much money as a hedge fund?
It's a good question. I think it was actually top 10 hedge funds versus top 6 banks, but it doesn't matter. It's an incredible number. I mean, the fact is these hedge funds together probably had fewer than 500 employees. The banks had 1 million employees, and the hedge funds beat them in overall earnings. This is a new kind of measure, by the way. Typically, you see these lists of which are the top 10 hedge fund managers, how much do they earn for themselves. This latest measure is how much do they earn for their investors as well as themselves. And so it's a fuller picture of how much they actually generate in the way of returns. And, you know, I wrote this history of hedge funds. I knew it was big. I'm still stunned by quite how big and how well this business model is done relative to all the competitors. It's not only more profitable, but it's also sort of more stabilizing, I think, for the marketplace because they're not too big to fail. They're small enough to fail. So they can take all this risk and make these returns without taxpayers underwriting them.
Rick Bensignor, what about low interest rates and the effect that this has on hedge funds' ability to leverage? Well, because if they're not being scrutinized by regulators, they can probably get as much leverage as someone is willing to lend them.
They're actually at the maximum level that they've been in the last couple of years since the crisis.
What kind of leverage are we talking about? Not 1 to 64, but something 1 to 20?
Yeah, I'd say we're back. They're probably back to close to 1 to 20.
So for every dollar of assets, of collateral, they can go out and borrow $20.
Yes. And,
wow.
And you wonder why the market.
Do that. They won't let you do that.
No, I only can do 1 to 19.
Wow, very good. That's how you got the purple tie. All right. So what is going on? I mean, if they get all this free money, of course, if they bet correctly, they're going to do very well against banks.
Well, sure. And that's the thing. The banks can't do it now with all the restrictions on the banks. They don't have the leveraging capabilities. Most of the major banks have curtailed their prop trading departments, so that's not a source of revenue the way it was.
We had the report from Goldman Sachs about the number. Was it 25 losing days of trades in the last month in February?
And one of the other major banks had no losing days in the last quarter.
Morgan Stanley, I think, was it? Or J.P. Morgan?
I think
J.P. Morgan. You're going to check that for me. I'm going to check it, too. So what does this tell us about where the money is coming from in the market? Is it all hedge fund money?
Well, a lot of it is fueled by hedge funds. The long-onlys, if you look statistically, we think, and most of the data supports the fact that most of the long-onlys get some incremental money, but not a huge amount. Their cash has been put to work, so they don't really have cash. So for a market to keep going on the upside like it is, you've got to have hedge funds buying and continually propping it higher. The public's certainly putting some money back into the market, and there's evidence of that from a variety of statistics. And as a side note, no surprise that the public, unfortunately, is most likely paying higher over the last year than where they sold out probably 2 years ago, which is typical buy high, sell low, buy higher mentality that the public tends to do, unfortunately. But it does go to the point that hedge funds have a tremendous amount of liquidity right now. They provide liquidity for the marketplace, too. And given this leverage factor, it really does just help keep this thing propped up. So you have quantitative easing that started last fall, or at least the announcement of it. That made a huge psychological shift in the marketplace, and basically the market's
psychological. It was just plain a lot of money.
It's an incredible amount, and one has to question the sustainability of this once QE2 ends. What's going to continually fuel the market? The economic
can't
numbers.
They have QE3? Well, we can count. Why can't they have QE3? Sebastian, come on this.
Yeah. I mean, I'd just like to inject one note of skepticism here, and that is on the hedge fund leverage numbers. I mean, the truth is twofold. First of all, nobody collects data systematically on how much hedge funds are levered. And second of all, the leverage term doesn't mean all that much because you can get levered exposure through off-balance sheet instruments, right, options and so forth, which wouldn't be captured in the traditional numbers. So everybody's kind of guessing. And I think rather than guessing, it's more constructive to observe that most hedge fund managers, and certainly all the reputable ones, have their own personal savings in the fund. They have skin in the game. So they're not typically taking as crazy of risks as the big banks that are managing other people's money. And that's why, insofar as there are numbers, right, heading into the 2008 crisis, we know that the typical investment bank was like 30 to 1 leveraged, and the typical hedge fund was 2 or 3 to 1 leveraged. That might have crept up. I would be stunned if it had crept up to 21, as Rick was saying. I really don't believe that. But whatever the truth, we do know the incentives at hedge funds are such that they are less likely to be crazy. And if they're generating amazing returns, I think they're doing it in a risk-controlled fashion.
Last question for you, Sebastian. Quickly, tell me, new private forms. They're going to have to disclose lots of information to regulators now. Is that going to change the business? Yes or no?
First of all, I think only at the margin. I think Dodd-Frank has regulated everybody else more.
We got to leave it there. Sebastian Mallaby, Rick Bensignor, thank you.